Welcome to this explainer on IFRS 3. Today, we are going to unpack exactly how companies account for buying other businesses, and we're going to do it without drowning in dense accounting jargon. If you follow the financial markets at all, you know that mergers and acquisitions are happening constantly, right? We're talking about billions of dollars moving around. But honestly, the real story of these massive deals is told in the accounting. So we're going to break down the actual mechanics of International Financial Reporting Standard 3, stripping away the complexities so you can see exactly how these corporate combinations are stitched together on the balance sheet.
It's kind of the ultimate question in corporate matchmaking. When the dust finally settles on a massive acquisition, how do we actually transparently combine those financial statements? You can't just take Company A's assets and mash them together with Company B's assets. There are hefty premiums paid, there are hidden intangibles, and there are incredibly complex liabilities. Without a rigorous framework, investors would be completely in the dark about what was actually purchased and at what true cost.
So, here is our roadmap for today. 1. Defining a business combination. 2. The acquisition method. 3. Valuing assets and liabilities. 4. Calculating goodwill. And 5. What happens after the deal.
All right, let's kick things off with Section 1, Defining a Business Combination.
Before we can even think about applying the accounting rules, we've got to establish the scope and make absolutely sure we actually bought a fully functioning business. Think of it like a corporate shopping cart. Buying individual assets is just picking up loose items off the shelf, but a business combination is acquiring the whole operating store. IFRS 3 specifically states that the standard does not apply to the acquisition of just an asset or a group of assets that doesn't constitute a business. See, in a simple asset acquisition, you just allocate the cost to the individual assets based on their relative fair values, and no goodwill is ever generated. But if you acquire a true business, that's what triggers the rigorous rules of IFRS 3.
To qualify as a true business, the standard outlines 3 essential ingredients: inputs, processes, and outputs. Basically, you need an economic resource, an input, like killer technology or an organized workforce. Then, you need a substantive process applied to it, which could be operational or management processes. Now, while outputs, like goods, services, or dividends, are obviously the ultimate goal, the standard makes a really interesting note. A business doesn't strictly need to have outputs at the exact acquisition date, just as long as the inputs and processes are capable of creating them in the future.
Which brings us to Section 2, the acquisition method.
This method gives us a highly logical, chronological, 4-step roadmap that literally every single deal must follow. IFRS 3 mandates that all business combinations be accounted for using this specific acquisition method. No exceptions, no old-school pooling of interests. We have to identify exactly who is buying, exactly when control shifts, what is being bought, and the premium paid. So, let's look at those first 2 steps.
The absolute crucial point in Step 1 is identifying the acquirer. Usually, this is the entity handing over the purchase price or issuing the majority of shares to get control of the acquiree. Most of the time, this is super straightforward. The bigger company paying the cash is the acquirer. However, IFRS 3 has some fascinating guidance for things like reverse acquisitions. This is where the legal acquirer, the one actually issuing the shares, is considered the acquiree for accounting purposes. It's pretty wild, but it often happens when a private company wants to go public without the hassle of an IPO, so they arrange for a public shell company to legally acquire them, but the private company's management is the one who actually takes control.
Step 2 locks in the acquisition date. This is the exact moment the acquirer officially gets the keys and takes control, which we most commonly call the closing date. This is the exact day the acquirer legally transfers the consideration, acquires the assets, and takes on the liabilities. Now, why does pinpointing this exact day matter so much? Well, because every single fair value measurement we are about to discuss is frozen in time based on market conditions on this specific date.
Moving right along to Section 3, Valuing Assets and Liabilities.
So, for Step 3, we have to open the books and measure the identifiable assets and liabilities we just assumed at their fair value on that specific acquisition date. And honestly, this is where things get really juicy for financial analysts. The acquirer will often recognize assets that the target company never even had on its balance sheet, like internally developed brand names or patents. Now, while fair value is our baseline rule here, there are a few highly specific exceptions we have to handle differently. IFRS 3 acknowledges that some items follow other established accounting rules. For example, income taxes follow IAS 12, and employee benefits like pensions follow IAS 19. Also, if the acquired company is a lessee, you generally measure the lease liability at the present value of the remaining lease payments. And indemnification assets, say where the seller guarantees the buyer against a specific loss, are measured on the exact same basis as the indemnified item.
Now for the fun part, Section 4, Calculating Goodwill.
Finally, we reach step 4, figuring out the magic premium of the deal, universally known in the accounting world as goodwill. Goodwill basically represents the intangible magic. It's the synergies and the unidentifiable benefits that make the entire combined business worth way more than just the sum of its individual parts. It essentially captures the value of things like a super knowledgeable workforce, expected future cost savings, or potential future contracts that just don't quite meet the strict definition of a separately identifiable asset at the closing date.
To find it, the math is actually pretty simple. We take what you paid, the consideration transferred, add any non-controlling interest, and subtract the fair value of the net identifiable assets. That consideration transferred includes cash, equity instruments, and the fair value of any contingent consideration. If this top number, the total cost, is higher than the net value of the assets you just measured in Step 3, that leftover excess is recorded right on the balance sheet as goodwill.
Now, what's really fascinating here is what happens if you somehow pay less than the net assets are worth. In that case, you get a rare discount called a bargain purchase, which is actually recognized as an immediate gain. This might happen in a forced sale, where the seller is just under intense pressure to liquidate. But listen, IFRS 3 puts a massive speed bump here. Before you can recognize this gain in your profit or loss, the standard forces the acquirer to rigorously reassess whether they correctly identified all the assets and all the liabilities. The goal is to make absolutely sure you didn't accidentally miss some huge hidden liability before you go claiming a bargain.
Finally, Section 5. After the deal.
So the handshake is done and the initial math is calculated. But how do we handle things when the dust settles and new information comes to light? Well, IFRS 3 grants companies a measurement period to finalize their provisional accounting. But it comes with a strict, completely non-negotiable limit of exactly 1 year from the acquisition date. When a massive deal closes, it's pretty much impossible to have perfect fair value appraisals done by the end of that very first reporting period. So companies publish provisional amounts. During this 1-year measurement period, they can retrospectively adjust those provisional amounts to reflect new information they get about facts and circumstances that already existed as of the acquisition date.
During this period, adjustments can be made to goodwill, and things like contingent consideration, which you probably hear called earnouts, must be carefully tracked and remeasured as future targets are hit. An earnout is basically an agreement to pay the former owners more money if the acquired company hits certain earnings targets down the line. If that contingent consideration is classified as a liability, any changes to its fair value caused by events happening after the acquisition date, like say, successfully hitting that earnings target, are not adjustments to goodwill. Instead, those changes are recognized straight in profit or loss. It is a vital distinction and it can massively impact post-merger earnings reports.
So the next time you see headlines about a massive corporate buyout, try to look past the PR. Ask yourself, what fascinating realities, what hidden liabilities, or clever earnouts will the acquisition method reveal when the dust finally settles? Mastering these steps absolutely changes how you look at the market. So what hidden value will you find in the next big merger?